All right. Today is Sunday, the 2nd of July. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. This is going to be a long one because we're going to talk about what else? The second half. You might look back and say, oh, the first half was really bad. I did not chase the AI mania, yada, yada, yada. But there's a whole half coming with a lot of changes, a lot of other opportunities, and a lot of risk coming. And you have to understand all of that to capitalize on it. Now, the scope of this video will be mostly for the market. If you're interested in any macro coverage, we did that in a previous video today, discussing the risk of reinflation versus recession and the confusion that goes on regarding economic data. But let's start with this. When we talk about upcoming opportunities, here's a chart for you, daily chart, beaten, bruised, absolutely hammered. And we have earnings coming in. Do you short this stock right now at this point, or do you buy the dip? Here's another one. Big crash so far. Earnings are coming in. It appears that we have a double bottom. Do you short this chart right now, or do you buy it? Here's another one. Big crash, perhaps really oversold. Is the opportunity right now in shorting this stock, or is the opportunity in buying the dip in this stock? Here's another one. Big crash, but it appears that we have a little bit of a recovery here, maybe a higher low. Do you short this stock right now, or do you buy the dip? Now, of course, this chart is the inverted chart of Tesla, and the chart before that was the inverted chart of NVIDIA, and the one before that was the inverted chart of Microsoft, and of course the first one was the inverted chart of Apple. Now, some of you might have caught that this is an inverted chart because the colors. So all I have to say about that is,
check out the big brain on Brad. You're a smart mother. That's right.
But anyhow, the point in making all of this is, in stock market bottoms, you see extreme fears. The headlines are doom and gloom. They're all about, oh my God, this is going to go down another 20%. In stock market tops, the headlines are usually euphoric and outlandish. So for example, this week we closed in Apple $3 trillion. And here comes the headlines. Apple stock has another 30% to the upside. The Johnny-come-latelys from Citi say. You might have caught my tweet on Friday. I said Apple market cap added this year $1 trillion. It's actually a little over $1 trillion. Yet the revenue growth is minus 2.5%. The net income growth is minus almost 3.5%. Now, folks would say, hey, don't look backward, look forward, what's about to come. Yeah, who's going to buy all of these iPhones? China, with the youth unemployment? Who else? The consumer here? The consumer who's weakening by the day? Who's about to have to repay their student loans again? But anyhow, to illustrate the absurdity, in 22, we also got the same headline, Apple $3 trillion. That was, of course, sell the news, and I believe this one is also going to be sell the news. But back in 22, Apple made more revenue. The year-on-year growth was 8.5%. The year-on-year growth this time around, the $3 trillion this time around, is minus 2.5%. And last time around, the year-on-year growth for net income for Apple was up 5.8%. This time around, it's minus 3.4%. So right off the gate, you can see that this is a bubble. This is a multiple expansion bubble, and all bubbles act and react the same way. It doesn't matter what names we're talking about, big caps, small caps, IPOs, doesn't matter. But we bring this point up to discuss the opportunities in the second half. Is it really in the names that ran way too high? Is the opportunity in chasing, or is there more attractive opportunities elsewhere? Because you look at the Qs, we're back to becoming expensive again. The PE multiples are surging higher, and interest rates continue to move higher, which means that the valuations relative to interest rates are more absurd today than 21. When we look back at the first half, it was led by information technology, aka the big caps. It was led by communication services, aka Meta and Google, and consumer discretionary, aka Tesla, Amazon. Yet the rest of the market is either flattish or negative. So the question becomes, are the opportunities in the second half in chasing the winners, chasing performance, or bargain hunting in these lagging sectors? Or is the opportunity altogether in shorting the market all the way down to the dumpster? Hold that thought. Regardless of the outperformance of technology equities, the smart money, the big guys, are actually using this AI mania and this rally to cash out. They were down in some positions last year. The rally made them whole again. Now, what are they doing? Are they chasing? No. We see net outflows out of growth by about 40 $4 billion. In other words, the smart money is cashing out. Well, how do you explain the fact that in the month of June, we actually had over $10 billion worth of inflows into ETFs, specifically technology ETFs? Well, here it is. Smart money versus dumb money index. Smart money in blue, dumping big time. Dumb money, aka us, chasing like never before. And the reason is we feel FOMO. The fear of missing out. You see bears capitulating, you see sideliners capitulating, and the majority of retail investors actually missed on this rally. So now they have to make up for that by chasing exactly at the wrong time. You see retail net inflows. After the SVB collapse, everybody became really careful. But then came June, and everybody started to capitulate again. And here's what I got to say to you. Chasing is dumb, and it's a guaranteed recipe to lose money. Because even if you believe in the AI mania, even if you believe in this rally, that this is the beginning of a new bull rally, you're gonna get better prices. You're gonna get a better dip to buy. Here's the chart of Google, weekly chart, for example. It appears weakening a little bit. Maybe it goes higher by a few percentage points here. But is that really the opportunity? Or is it if Google goes down? And then it forms a reverse head and shoulder formation, and you get to buy it at a cheaper price. Even if you believe in the AI mania, and Google is a modest example, if you look at other charts, they're way out of whack. You gotta get better prices, I promise you. But the problem with the chasing mentality, it is typical of us retail investors, because this is the only way we've been taught on how to make money in the stock market. Look at stock so-and-so. It was a whatever price, and now it's up 300, 400%. If you invested at this point here, now you made this. We've been taught this from the get-go, that this is the only way you can make money in the stock market, is chasing. But the question then becomes, are you investing in the long run, or are you chasing a bubble? Because all bubbles act and react the same way. I tweeted this today, the track record for the "this time is different" crowd. Since 2020, forget about the dot-com, the housing, forget about all of that. Since 2020, which is ancient history right now. Nobody recalls, nobody remembers what happened since 2020. Stay-at-home mania failed. Vaccine mania failed. IPO mania failed. EV mania failed. RK mania failed. Crypto mania failed. SPAC mania failed. Meme mania failed. But now they tell us, oh, the AI mania. That's the one that's going to be different this time. And these cockroaches are all over Twitter right now, saying, oh, you missed out on the rally, you missed out on the rally. Just so you know, most of these folks, as I showed you in the data, the retail mom and pops, they did not participate in this rally. Most of these folks are bag holders from 2020, and they've only made whole now. They've been holding a grudge since over a year ago. So now they keep going on Twitter and saying, oh, you missed out on the rally, you missed out on the rally. Oh, really? I recall back when I was told during the vaccine mania that I missed out on the rally on Moderna because it was so critical. But it is documented on this channel that I shorted Moderna, not exactly at the top, but really close. Money was made in the upside, more money was made in the downside. It's a zero-sum game. Somebody wins, somebody loses. All bubbles act and react the same way. There is no such thing as it's different this time. Here's another one. Stay-at-home mania, Zoom, exploded really higher, and I was critical of this mania. And I was told, oh, you're missing out, you're just jealous, bruh. Zoom, it's the new future, bruh. Okay, so we shorted Zoom, and look at what happened to it. Money was made to the upside, mostly for the insiders in the executive suite. And then, of course, money was made on the downside when it crashed, but somebody held the bag in the process. And most of these bags were held by the retail mom and pops, the chasers. Here's another mania, RKK. And again, you can go back to the videos that we made in January 21 when I said I was shorting RKK, pretty much exactly at the top. What were the comments? Oh, you're missing out, you're just jealous about Cathie Wood making a lot of money. You're gonna lose, bruh. Look at what happened to it. And where did all of that money go? From the chasers of the RKK mania. The answer is, it's in my pocket. It's in the pocket of the shorts who shorted this name. Money was made in the upside for those who sold. Money is made in the downside for those who shorted. End of the story. It's a zero-sum game. There is no such thing as missing out. All bubbles act and react the same way. Money made in the upside, money made in the downside. Here's another one. I did not short this one though. The SPAC mania / the EV mania, Lucid Motors. Look at this. We were told that this is different this time. Oh, SPACs are the real deal. Lucid will change the world. You have no idea what you're talking about. Here it is now. The IPO mania. Here it is. Everybody told us that, oh, Coinbase is the future, bruh. Rivian, Bumble. honest company, all the garbage IPOs that we got throughout 2020 all the way to 22. Well, they came down crashing. And who sold right at the top? The executives, the insiders. And who held the bag when the crash happened? The chasers, the retail mom and pops. So today, when we look at NVIDIA and you see this massive rally, you think of two things. If you happen to be a regular retail mom and pop, oh my God, I missed out. Look at this. Look at all of the money that was made. I missed out. And the second thing is, you look at this chart and you say, okay, this is not going down. Everybody who told us that this is going to go down, NVIDIA is a bubble, they've been wrong. The chart keeps going higher and higher and higher. You know what? I've seen enough. I'm going in. I'm buying now. Even though the chart itself, the same chart that you're looking at right now, it tells a different story. Here's a rally. Lots of money made in the upside, chasing the mania in 21, and then it came down crashing by about 68%. Money was made in the upside, mostly for those who cashed in. The executives, the insiders, and then money was made in the downside for those who shorted. It's a zero-sum game. And now what we see here is massive rally, lots of money made in the upside, and there is a lot of money to be made in the downside. All bubbles act and react the same way. And for some of us who have experience in this kind of regard, of going long stacks but also shorting stacks, you look at this chart and you see the opportunity. Because if we invert the chart, as we did in the beginning of the video, you'll see a severely oversold chart that is worthy of buying. From the eyes of the short, you look at this is a mania, this is a bubble, and what comes next is where the real money is. And of course, the worst case scenario is if this chart marks the top, a generational top, as we've seen during the dot-com bubble, for example. The poster boy was Cisco, the poster boy today is NVIDIA. And look at Cisco's chart since the dot-com bubble. Never recovered. If you chased at the top of the mania, it's been over 20 years now, and you haven't made your money back. So what are you saying here, Maverick? Should we just go all in and short NVIDIA from this point? It's going to work this time around? Not like the time before? That's not what I'm saying. Matter of fact, I would say to retail mom and pops, shorting is a tough business that you should not be involved in without experience. There are actually other opportunities that could present themselves in the market right now. A lot of them in the long side. We look at S&P 500 in white versus the RSP in orange, which is S&P 500 equal weight. Before the month of June, the criticism from people like me was, hey, look at this. We have a massive gap in performance here. S&P surging higher, equal weight S&P is actually negative. So the rally is led by a handful of stocks. How could you trust that? How could you call this a bull market? Well, since June, we have seen the RSP catching up. Now, it could be a false move and all of them come down together later on. But right now, looking at the chart right now, where is the opportunity? Chasing the SPY, what already worked, or the laggards that are perhaps about to catch up? I think the answer is clear. We've been saying this since we started talking about the rotation. Now, when we look at these divergences, to be fair, there are two ways we can look at them. We can look at them from the bearish perspective, and there is plenty of those to look at. The divergence between the market and copper, divergence between the market and the HYG, the divergence of the market and the bond market. And look at this, for example, from Liz Young. Valuations of the S&P 500 versus the real 10-year Treasury yield inverted. You can see that we have a massive divergence here. Either the stock market is telling the real story or the bond market is saying the real story. Because the stock market says expansion based on the AI mania. Bond market, which is more reliable, says no, we have a recession coming. The Fed will continue to raise rates and they will get us into a recession. So this is an important divergence to keep in mind. But to be fair, we have to look at it from the bullish side too. And for all of you bulls and the perma monkeys, of course, you sound really dumb on Twitter when you go in debates with people like me, for example. And all of the argument you got to say is, oh, but it's different this time around. Stocks always go up. It doesn't matter. The fundamentals don't matter. All of that is dumb, and it just makes you look stupid. But I'll help you here. I'll give you a good, perhaps the most solid piece of bullish evidence that you want to use to argue that the stock market will go back to all-time highs, if not even exceed that. Here it is. We look at the U.S. Economic Surprise Index and the S&P 500. There is a clear correlation here. Of course, when you see divergences, as we've seen during the summer rally of 22, it is a sign that it is a fugazi rally. Right now, we don't see that. We see the U.S. Economic Surprise Index actually confirming the rally and suggests that it should go back to all-time highs. Now, if that's true, and we're about to go back to all-time highs, what kind of stocks will lead this second half rally? We'll look at the Qs versus the IWM. If the chart is moving down, it means the IWM is outperforming the Qs. If the chart is moving higher, it means Qs outperforming the IWM. You can see that we have a peak in the outperformance of technology, the Qs versus the IWM small caps, the Russell 2000. It is almost inevitable that the Russell 2000 will start to outperform the Qs. Now, does that mean that the IWM is going to blast higher and the Qs will stay static or even sell off? Perhaps. That would be the bullish explanation. There is the bearish explanation, which is, no, the IWM is going to outperform the Qs because we will see an inclusive crash in the stock market led by the Qs. So Qs goes down 15-20%. IWM goes down 8% because it's already been battered and bruised. That's the bearish way to look at the upcoming shift in performance. But here's another one. The Qs versus the SPY this time around. Every time the chart moves higher, technology, the Qs outperform the SPY, meaning the rest of the market, including cyclicals, including value. Huge outperformance by the SPY since 22 all the way to 23. But this year, we see technology rebounding significantly higher and crushing the SPY. In 22, when the SPY was outperforming, we saw value outperforming growth. In 23, when the Qs outperformed the SPY, we see growth outperforming value. In other words, if we believe that this is the peak outperformance of the Qs versus the SPY right now, and it is inevitable that the SPY is going to start to outperform the Qs, which kind of stocks are about to lead this outperformance? The answer is not the ones that led in the first half, not the technology names, not the AI mania names. It's going to be a different set of stocks, and perhaps led by value, which could be welcome news to me at least, and a lot of people who follow this channel, because at least for me, the majority of my long portfolio is in value. It's not in growth. If we start to see this kind of outperformance, we could see sectors, lagging sectors, such as healthcare, energy, defensives, metals, all starting to outperform again. And that leads us to the rotation. Now, the rotation so far has been led by the soft landing premise. So we see the IWM outperforming. We see cyclicals such as travel, cruises, airlines, regional banks, retail stores leading the rotation, at least so far. Now, in contrast, the yield-driven rotation into high dividends, healthcare, real estate, utilities has been lagging. We see a few days where we see that kind of rotation, but for the most part, it hasn't worked out. Now we look at the dollar-led rotation. It has been working for a little while, then it stops working. So we see Chinese names rebounding, then they go down again. We see energy names rebounding, then they go down again. So the consistent theme so far, specifically after the hot economic data that we got, is the soft landing rotation into IWM, cyclicals, regional banks, and retail, which is, by the way, my least favorite rotation. Here's why. Understand that the Fed funds rate is expected to go higher. The Fed says we're going to raise more. The bond market says they're going to raise more. What does that mean? More stress on zombie companies, more stress on banks, specifically regional banks. We look at the IWM, for example. The percentage of companies that are unprofitable in the IWM is almost 40%. These are zombie companies. So if we see rates going higher, do you really want to be in these names that could blow up any minute because rates are too high? Do you want to be in the regional banks? Not me. I'm not saying they're not going to catch a bid. It is inevitable that the IWM is going to outperform the Qs. But the question is it the smartest rotation? The answer is absolutely not, because we have yields going higher, because we have the Fed funds rate going higher. And that brings us back to the yield-driven rotation into high dividend stocks, healthcare, real estate, utilities. If we expect rates to go higher, I mean, look at the chart, the 2-year yield. This is a weekly chart. Does this look bearish to you? I see it going higher. I mean, the chart says higher we go. You look at the monthly chart, we're at the same levels right now before the GFC, the same levels that blew up Lehman. So unless we see a change in trend in this chart, we can't really have high conviction into the yield-driven rotation. If we look at the expectations for the July meeting by the Fed, it says 84% chance that they're going to raise rates by 25 basis points. And if we look all the way into the next meeting in September, we have about 20% chance that the Fed will raise again, and that probability could increase significantly higher between now and then. In other words, is it the smarter rotation? The answer is not really. Now, that doesn't mean that some of these sectors are not going to outperform. For example, we look at the XLP consumer staples, the ETF for consumer defensives, which could be either in the dollar-driven rotation because the dollar goes down. It's positive for these kind of companies, but they also happen to be high dividend paying names. If yields go up, then they become less attractive. Look at this chart, weekly chart, consolidating within a range, did nothing at all, did not really suffer in the bear market at all. But what do we do here? Can it go higher? Sure. There are a lot of indicators that we could use to say, okay, this is going higher. But then you look at the diamond topping pattern, and there is a significant degree of risk here. It's not the sexiest chart. Now we look at healthcare, the XLV, it looks a lot better. Maybe you're on the cusp of breaking out. So can we see a rotation into healthcare? The answer is absolutely. Is it the highest conviction rotation? The answer is not really, because these names are high dividend paying names and they become less attractive as bond yields move higher. But if we're going to rotate here, if you're going to follow this one, you see the opportunity here, stick to the ETF, the XLV, because you might buy Pfizer. Then we get bad news for Pfizer. Stock goes down. We might get bad news for Eli Lilly. Stock goes down. So I would say if you're not into healthcare and you want to get into healthcare right now, the best way to do it is to buy the ETF XLV. That said, take the guessing game and the individual picking name out of the picture and stick to the ETF in this case. Now, when we look at the dollar-driven rotation, which is my favorite because it goes hand in hand with reinflation, of course, we have China. That's a negative, unless, of course, we get stimulus out of China. But you look at some of these charts. We look at the XLI, for example, XLI industrials. You look at this ETF. We talked about the bullish formation here. It is breaking out. It is challenging the highs. This chart never was in a bear market, really. It has been consolidating for years now. Is it time to go long industrials here and chase this outperformance? Maybe this is where we should rotate. I would say not so fast. You look at the daily chart. You plug in the Bollinger Band. Not the best time to buy right now. Maybe you should wait for a pullback. If it holds, then it could be worthy to rotate into the XLI industrials. But in this case, I would favor choosing individual names, not the ETF. And I'm going to do my portfolio review for the members tomorrow. We're going to talk about these individual names. So if you're not in, consider joining. Then we'll look at the XLE Energy. Laggard for the year, been consolidating for about a year or so, but maybe the technicals are now improving. Too early to say, but it could be an opportunity for a rotation if we have a reinflation summer. If that's the case, energy goes higher. There's an opportunity here. We'll look at the XME metals. This is a weekly chart and we can see that the momentum is improving. Looking at the RSI, the MACD indicators, the chart is making a higher low pattern. It caught support plenty of times from the support zone. This could be the opportunity here. If we have a reinflation summer, then we should see metals leading the rally. Now, in this case, do you go with the ETF or you pick individual names? The answer is, in the case of metals, you want to pick individual names because if you buy the ETF, now you have exposure to gold, steel, chemicals, fertilizers. All of these are different plays. So you want to stick to individual names here. We're going to talk about them tomorrow. But most importantly, before you get excited here, and you chase these rotations, specifically this one, it's not confirmed until the dollar goes down. Here's a weekly chart for the Dixie. We can make a bullish case and say, look, this is a reverse head and shoulder formation, a triple bottom. Doesn't matter how you look at it, but higher we go because the Fed will have to be aggressive and the dollar is going to firm. If that happens, this will be a lousy rotation and you don't want to follow it. Now, on the other hand, if the dollar goes down and it breaks this consolidation range, that would be a confirmation for the dollar-driven rally. The dollar-driven rotation into cyclicals, into metals, oil, industrials, and many more. So now you know when you look at all of these rotation possibilities, you know how to confirm them. The high dividend names, healthcare, real estate, utilities, you need to see yields not necessarily moving down aggressively, but stopping the impulsive rally higher. If you want to see the dollar-driven rotation happening in Chinese stocks, staples, commodities, energy, industrials, metals, you need to see the dollar calming down and trending down. If you favor the soft landing rotation into the IWM, cyclicals, regional banks, retail, you need to see more and more positive economic data when it comes to the consumer and spending in the economy. And so far, the consumer is not doing that good. And this is why I'm cautious about all of these rotations. But if I had to pick one, I'd go with the dollar one. But if the dollar starts to rally, we got a problem. Now, let's recap the first half of the year and look to what we have in the second half, because this is really important. We start the year in the month of January. What do we see? Typical short covering rally, booking profits from the shorts. Nothing to see here. Nothing new at all. Typical behavior. The expectations are the bear market is going to resume after all of these short covering rallies are over. Then comes the news of Microsoft investing in OpenAI, and that ignites and starts the AI mania rally. So we see stocks shooting up higher. Then comes the month of February, and we get data about inflation rebounding, and we see stocks going down because now the expectations are, oh my God, the Fed is not going to pivot. The Fed will have to do more. Then comes the month of March. The banking crisis begins. We see the collapse of SVB, and stocks go down. Then the Fed announces the lending facilities, and the market looks at the collapse of SVB and the banking crisis as an opportunity that perhaps it gets us closer to the Fed pivot and the end of quantitative tightening, and stocks recover. Then we get into the month of April and May too, and nothing happens. We have debt ceiling negotiations going on, and we see stocks consolidating, doing nothing at all for about 2 months. Then comes the month of June, and we see the FOMO rally beginning, with retail investors finally capitulating. And this happened after we got the news from NVIDIA, the revenue upgrade. We also got the Fed pausing interest rate hikes, and the chase begins. The FOMO rally begins. Stocks explode higher, and now we have an official call that we have a bull market. This is what we have so far this year. What do we see in the second half? Here it is. In July, we have an important jobs report because it shows the data for summer hiring and wage inflation. And then we have, most importantly, big tech. All of these stocks shot up higher. Now comes the day of judgment. Are they going to live up to these valuations? Are earnings going to come out good? If they come out disappointing, we're going to see massive reckoning here. And of course, we have the June CPI, which is supposed to be a bullish catalyst because the reading is going to be about 3%, in the threes at least, due to the base impacts. So could that be a catalyst to add more fuel to the fire in the mania? Something really important to consider. And then in the month of August, we get NVIDIA's earnings. We see if that revenue guidance was real or not. And of course, we get the July CPI. Why is the July CPI really important? Because the base impacts disappear, and we might get a massive rebound in inflation. We jerk off in July to, let's say, a 3% handle in the CPI, then it rebounds higher back to the fives in the month of August. And then what happens? Jackson Hole. Here's Powell, comes out again with more pain coming. We could have Jackson Hole 2.0. Then in the month of September, we finally get the interest rate decision by the Fed, given the recent data that we're about to get in the month of July and August. And of course, we get the resumption of student loan payments. In the month of October, we expect household excess savings to disappear. So you look at what we have, what's coming. We have one bullish catalyst, potentially more, but one that we know in the bag, which is June CPI. Now earnings, it depends on how good or bad they are. NVIDIA's earnings, same story, but then we have a lot of bearish stuff going on. July CPI could be a disaster. Jackson Hole could be a disaster. The Fed interest rate hike in September could be a disaster. The resumption of student loan payments could be a disaster. Households' excess savings running out. Who's going to stimulate the economy? So we have a lot of things that could be really different than the first half of this year. And it all ties up to the wall of hope. We talked about the wall of worry in a past video, discussing the unknown, the black swan that could come anytime here. It comes out of the wall of worry. So go back and look at that video. But here we talk about the wall of hope that initiated this rally year to date. The hopes of China reopening, which are now dashed. The hopes of Fed and central banks pivots, an end of quantitative tightening. That comes and goes depending on the data. But the Fed has been clear. The job is not done. Jerome Powell from Spain this week suggested that the Fed's target of 2% is not going to be reached until 25, but nobody's paying attention now. Perhaps a hotter July CPI and a Jackson Hole moment will seal the deal on this hope and kill it entirely. And we have the hopes of AI. What if these technology companies reporting earnings don't show any benefit right now from AI? And all what we see is declining margins because they're spending more on AI, but we're not seeing the revenue yet. And of course, comes the moment of NVIDIA's earnings. All of this mania got initiated because of NVIDIA's revenue guidance. If they blow up this guidance, then we know that the AI mania was a bubble, a hype. And then what do we have on the wall of hope? If China reopening is gone, if the Fed pivot is gone, if AI hopes are gone, then what do we have? We have nothing. And then who starts to take place and hold of the stock market? The answer is bears. Bears are going to make a comeback. Now, of course, there is a bullish outlook, and we discussed that in details. The surprise index, suggesting that the S&P will go higher. The rotation could lead us higher. But boy, the landmines that we have in the second half, you cannot dismiss that. Even if you're bulls of all bulls, you cannot dismiss that. So now we go back to my conditions of shorting with both hands. Are we here? Are we getting there? Do we have a fundamental reversal? The answer is not yet. But if you look at the wall of hope, if all of them are gone, then we have fundamental reversal. If we have a Jackson Hole moment 2.0, if we have AI earnings not coming out pretty good, then we have a fundamental reversal. Do we have a technical reversal? We have the majority of that, which is extended weekly hour size, but we don't have a reversal candle yet. You look at the Qs, for example, weekly chart, the hour size are the zone where you want to be, let's say, cautious, not optimistic, or even shorting. And the question now becomes, are we seeing a distribution pattern as we've seen in the late 21 rally? But you look at this chart, okay, you got the extended weekly hour size, way out of whack, but do you have the reversal candle from weekly basis? The answer is not yet. We look at the mechanical reversal, extreme call options positioning plus unusual big shorts coming in. We look at this, we have extreme call options buying, we know that, but it appears to be peaking and reversing. So we got a check mark here. Now, we've been covering this on the channel for a while. At least this week, we have seen quite unusual options trades in shorting the indices. We covered an $80 million trade against the Qs for the month of December, and now they're doubling down. Look at these unusual trades that we got on Friday. Somebody bought the 330 puts for the expiration date of December 15th, and they're adding to that position. They've already spent about $80 million on it. Now they're spending even more in averaging down. All of the call options trades are 0 DTEs, 1 day, 2 days till expiration. You look at these big trades with more than, let's say, 2 days till expiration. Most of them are for puts. You look at the SPY, it's the same thing. In the long run, any trade above, let's say, 2 days is all for puts. So we're starting to see this kind of stealth bearish positioning. By who? By the pumpers, by the institutionals, who are telling us to buy, but they're already preparing for the disaster, for the slaughter. And these are the kind of signs that I look for before placing massive shorts. Right now, what do I have? I have a mechanical reversal. I got a check mark on that. Technical reversal, I got maybe 90 to 95%, but I don't have a reversal candle in the Qs, so still not a check mark. And of course, the most important one, the fundamental reversal. We don't have a check mark on this one. We're waiting for it. We have potential for it for the second half. And if it happens, the market is going to revert, the leadership in the market is going to revert from mechanical to technical back to the fundamentals. The fundamentals are going to lead, then the technicals, then the mechanics. But as the sell-off comes, the mechanics will start to take over at some point, and then we get the climax and a bottom. That's how it always works. Now, if you look at all of these three factors, fundamentals, technicals, mechanics, in the first half of the year, the fundamentals were not on the side of the bulls. That's for sure. But the technicals were, because the stock market became really oversold. The sentiment was overly bearish, so they got a check mark on that one. The mechanics. Look at what happened to Tesla in the month of December. Reverse gamma keeps going down every single day, but it peaked. It was insane amount of put options bought, and we started to see big, unusual long bets on Tesla, suggesting that the bottom is near. And indeed, it worked out this way. Now we go to the second half. Are the technicals on the side of bulls or bears? At least in the Qs, they're on the side of bears, because the RSI are way overloaded right now, way out of whack. You look at the mechanics, are they on the side of bulls or bears? The answer is on the side of bears. They have peaked in the bullish performance. Call options went out of whack versus puts. We have seen lots of gamma squeezes. In some cases, we have already seen the climax. And the fundamental case has always been bearish. And it's led by the Fed tightening campaign. So we enter the second half with the mechanics and the technicals reversing slowly, but be it it's happening, to the side of bears. And the fundamentals have been always on the side of bears. So while we have some bullish optimism of the continuation of the mania for a little while, or even a rotation into the lagging sectors of the stock market, we can also see the risk here that things can go bad really quickly. And all of these three factors could shift from one camp to the other. And with that, folks, we move on to the market coverage, and we begin with the closing of the indices on Friday, and here we go. The Dow Industrial Average closing positive by 285.18 points, or a gain of 0.84%. The Nasdaq leading the pack by 196.59 points, or a gain of 1.45%. The S&P also closing positive by 53.94 points, or a gain of 1.23%. Look at these sectors' performances across the board, all closing positive, led by technology. We have a lot of rebalancing showing up, but we're going to see the end result next week. But all in all, everything caught a bit on Friday. If we contrast this with the week, again, all sectors are positive, but this time around led by real estate, industrials, and energy. So a little bit of a rotation going on here. Of course, we're going to see the end results next week, but it is really interesting that we see real estate leading the bid, industrials, energy. But it was not an actual rotation because we don't see communication services or technology in the red, meaning money coming out and then money chasing real estate, industrials, and energy. We're just seeing more inflows, but these inflows are chasing the laggards more than the winners. We look at the breadth all in all on Friday, pretty good. NYC 67% advancing versus 31% declining. The Nasdaq 52% advancing versus 44% declining. So in the Nasdaq's case, big rally on Friday, but only 52% advancing. So what does that say? The rally was led by the big caps. Moving on into commodities. What happened on Friday? Green across the board. Few exceptions here. We see energy commodities doing pretty good. Whether we're talking about crude oil up about 1% a piece on Friday, but it's been natural gas all week, all month, up about 3% on Friday again. We also see some rallies in softs led by cocoa, sugar, and cotton futures. And finally, the dollar-sensitive metals. Since the dollar went down on Friday, we see a rebound in gold, silver, platinum, but mostly copper, which was up about 1.75% on Friday. And then meats, they continue to go higher. Grains, gains across the board. Look at soybean oil. Massive gains on Friday alone. Although we saw corn going down along with wheat, big losses here. But they've been, at least in the case of wheat, winners quarter to date. The thing with corn is, with all of these wheat fields going bad, farmers are choosing to plant corn instead. So we're going to have an excess supply of corn, a shortage in wheat. Now, when we look at the month-to-date performance, what do we see here? Look at this. You want to talk about reinflation? Here it is. Soybean oil up over 30% for the month. Natural gas up over 20% for the month. Canola, oat, lumber, cocoa, lean hogs, soybeans, wheat, all of these commodities, they beat the Nikkei. They beat the Nasdaq. They beat the S&P 500. They beat the Dow Jones. They beat European equities. So commodities are now charging higher, and they're beating equities, even the AI mania. This is really interesting to keep in mind when we talk about the prospects of reinflation. Moving on to options, the big casino, what do we see here? The volume picked up higher on Friday, but it is not unusual because we have rebalancing. But still, calls are outweighing puts by a huge margin here. They're coming down a bit, but not enough. You see huge volumes in Tesla, Apple, 2 million apiece. We see about 60% of this volume bought as calls, not puts. You see NVIDIA, number 3 with about 1.3 million contracts traded on Friday. About 55% of those were calls. But the majority of these gamma squeezes in these names stopped. We're talking about Tesla and NVIDIA. We see the gamma squeezes still alive in names such as Carnival Cruises. Lots of buying here in calls. We see it in the Carvanas of the world. We see it in the small caps, SoFi. Those names are still hot when it comes to the gamma squeeze. There's a little more to squeeze here, but they're going to go down big. Yet we see the gamma squeeze in Tesla and NVIDIA kind of stalling. Maybe we have a new one in Apple because of the $3 trillion valuation, but it is extremely hard to squeeze Apple. And therefore I say there is a risk of sell the news here. And since we see the risk of sell the news in Apple, here's the trade that I got into on Friday. I bought a butterfly call spread, which is basically buying the 205 calls with the expiration date of August 18th. Cost you about $1.50 a piece. And then we sell 2-to-1, the 210 calls with the same expiration date. And you pocket about 75 cents a piece. If you do 2-to-1, you're pocketing $1.50, so that cancels the cost of buying the 205 calls. And then we buy the insurance leg in the butterfly spread, which is the 215 calls, same expiration date, cost you about 40 cents a piece. And then we look at the bearish leg, which is a put spread, basically buying the 185 puts, expiration date August 18th, cost you about $3 a piece. Then you sell the 175 puts, same expiration date August 18th, and you get about $1.20 a piece. All in all, the entry cost for this whole structure right here is about $2.20 a piece. The max profits are about $10 a piece, and you have exposure to both upside and downside. Why are we using this strategy? If you look at the chart for Apple, you plug in the Bollinger Bands on the daily chart, we're due for a big pullback that takes us all the way down to the 20 days moving average at a minimum, and that coincides with 185. But then, if we zoom out a little bit, here's the trade. As you can see, the butterfly spread, the call spread, in case we have a continuation of the mania, it takes us above 200. You can still make profits if the stock closes above 205 by the expiration date. It's not the most ideal scenario, but you still have exposure if we have more upside coming. Now, if we see a pullback right away, sell the news, and the stock goes down to 185 and then all the way to 175, that is the ideal scenario. And again, we're not betting on a crash here. We're just betting on a pullback, a decent pullback that takes us all the way down to 185, if not all the way down to 175. You can flip a trade that cost you $2 a piece to $10 a piece. That's a huge profit. The worst case scenario for this trade is if we see Apple consolidating within a range, 185 to 205, all the way till the expiration date. Then the trade loses. But again, we're just risking $2.20 a piece. Now, this consolidation scenario, if you go to the roulette table and you bet black, red, couple of numbers here and there, and then the ball lands on 0, on green, then there's nothing you can do. And in this case, if the stock consolidates within a range, that would be the equivalent of 0 or double 0 on the roulette table, and the trade loses. Now, let's look at the unusual trades done by others, perhaps much smarter than me, and see what's going on here. We start with, here it is, another butterfly spread for the SPY this time around. Now, the butterfly is neutral because in my case, in my Apple's case, I say, okay, maybe it goes higher. I'd like to have some protection, some exposure to that effect. but I don't think it's going to go much higher from here. So it serves as insurance for the short leg. In this case, somebody's betting that the SPY will go down big, but they're using a butterfly spread. Why? Because they don't want to spend a lot on it. They see downside coming, but they don't think that the SPY will be below 380 by the expiration date of August 11. Now, the 380 leg in this trade, in this structure, is the body of the butterfly. How do we know that? Because the volume is double the wings. The wings, the 395, the 365s, they're half of the volume of the body of the butterfly. So the trader, the main leg that they're betting on is the 395 puts. And then they sell 2-to-1 the body of the butterfly, which is 380, but they have to buy the insurance on top of that, which is 365, in case the SPY goes below 380. Because if that happens, the trade will be flattish. You sold twice the volume that you bought. So what is the insurance here? 365. In case we have a huge flush down in the SPY, the trade is not going to go against you. And the expiration date, once again, is August 11th. They see the SPY going down by more than 10%, but not more than 14% by then. They sold the butterfly body, the 380, for 40 cents a piece. But again, they're selling 2-to-1, so they actually got 80 cents a piece. They bought the 395 for about 60 cents a piece, and they bought the 365 puts for about 30 cents a piece. All in all, they spent about 90 cents a piece, but they received 80 cents a piece from selling the 380 puts. All in all, the entry cost for all of this is only 10 cents a piece, practically nothing. So if you want exposure, downside exposure for the SPY, if you fear a crash could come, why not follow this trade? For nothing, cost you nothing. And then we have a trade against the Qs, the Nasdaq. Somebody bought the 335 puts, expiration date September 29th, with expectations that the Qs will go down and lose more than 10% of its value by then. They paid about $3.60 a piece to enter this trade, all in all spending about $5 million. And last but not least, at the bottom of the table, what about the ticker UPS? You know we have the upcoming union strike, but what if we have a deal before that? Then the stock is going to rebound higher. Somebody's bidding on that, perhaps insider information, who knows? But they bought the 195 calls for the expiration date August 18th, with expectations that UPS will rebound and gain over 9% by then. They paid about $1.70 a piece to enter this trade, all in all spending about $1 million. On to the heat map for Friday. Here it is, green across the board. Everybody's a winner, exception of course Micron and chips. These are the notable exceptions. Nike and cyclicals, and of course we have the regional banks. Can we read anything here? Does this kind of action offer us any guidance here? The answer is of course not. It was a rebalancing day, rebalancing week, but we haven't seen the result yet. That comes next week. So the feedback from next week will be more effective than this week. We contrast this with the weekly heat map. What do we see here? All of a sudden, healthcare is doing really bad, at least the big pharma names. Pfizer is trash. I had to get rid of it earlier this year because it has been a consistent underperformer over and over and over and over again. We also see Google underperforming in big caps, big time. We see the Chinese names underperforming. In chips, it is notable that Micron is underperforming. That's due to China, TSM, Taiwan. That's also connected to China. And now we have Janet Yellen flying over to China. We'll see what she brings, but you look at these staples, some weakness here because we got GIS earnings, General Mills, and we see that the consumer is getting significantly weaker, and therefore the pricing power of these companies is diminishing. So we see GIS down, we see Coca-Cola down a bit, but besides that, it has been a positive week across the board. And it is interesting that we see some migration toward the south. We see energy catching a bit, metals catching a bit, real estate, industrials, some healthcare, banks. So for now, it's just inflows coming in. The question becomes, not all rotations are created equal, as I showed you in the intro of this video. Which one will win? The yield-driven rotation, dollar-driven rotation, or is it going to be the soft landing-driven rotation? That's what we're about to find out in the second half. Now, there could be no rotation at all. None of them are going to stick. And the real rotation would be to the dumpster, dumping everything, because we have systemic risk, because perhaps we have black swan, because the July CPI came out really hot, and Mr. Jackson Hole comes back. All of these are possible scenarios. But right now, we have to keep an eye on what's going to happen immediately. Are we going to see a rotation? Most importantly, where? And And now you know how you can confirm these rotations. Instead of just following whatever rotation and then blows up in your face, now you know you have to watch yields, you have to watch the macroeconomic data, you have to watch the dollar. Anyhow, let's look at the ETF heat map for the week. What do we see here? Much better action than before, and the reason is we see mid caps outperforming, we see value outperforming, we see small caps outperforming, and it would have been better had we seen outflows out of large cap growth, out of the AI mania, into the cyclical side of this map. Because had that happened, we would have said, okay, we have a rotation here. They're taking profits, they're rotating all of these profits to other sides of the market. But right now, all we see is just inflows coming in. It was a pretty good week for energy. You see the XOP, XLE, OIH, massive gains for the week, massive gains for real estate, IYR, massive gains for XME, metals, the laggards, XLU, utilities, XLP, consumer staples, aka the high dividend paying names, XLV, healthcare. They're positive, but they're lagging. So that kind of rotation, the yield driven rotation, is not really working. It's the dollar driven rotation that is working right now, along with the soft landing rotation. Keep an eye. Anyhow, let's do some charts here and then wrap it up. We begin with SPY, 30 minutes chart. What do we see here? Massive gap higher on Friday, but again, now we're becoming overbought in the RSI. So we're looking for a pullback, and that pullback could be small or big. We can go down all the way to closing the gap and then rebound higher. The gap is going to be at around 439.45. Or we have to go down to close the gap below, which is 438. That would be disappointing. You know why? Because it would mark the potential of a double top. You lose 438, then you got the support zone. You lose the support zone. 430, still an uptrend. You lose 430. Say goodbye, but one step at a time. Here's the daily chart for the E-mini futures. The S&P, what do we see here? It closed above 4,472. Is that bullish or bearish? The answer is, it is bullish. We see the momentum indicators firming up again in the RSI and the MACD. Is that bullish or bearish? The answer is, it is bullish. If the rotation takes place, then we're going to see higher highs for the SPY. Can we identify a more immediate resistance here? The answer is sure. We have to zoom out in the chart. You got all of these markings from all of these years still here. It's a mess. But looking at the chart, we pick up an important reaction here, which goes all the way back to the month of April of 22. And that level is 4509. Exactly. So we plug in 4509 and we zoom in. Uh-oh, we're almost there. Which the bears would argue that this is a double top now. And then down we go, forming the Maverick of Wall Street logo. And if that happens, I'm going to retire. Goodbye. You want to know what my feedback is? Look at the chart. I don't need to do the show anymore. But all joking aside, let's use the SPX this time around, the cash index, 30 minutes chart. We talked about the wedge pattern. We talked about the bull flag consolidation, which should take us higher to close the gap at 4409. Well, we got way below that. We opened a massive gap now. The RSI is way overextended, and we might have a double top formation here, which means we should go back and revisit 4409.60. We got to reconcile that. And then if we have a rebound from that point on, we see the SPX moving higher, it will be led by the rotation. If it cracks, closes the gap below 4409.60 and keeps going down, then we know that we have a double top. Next stop would be 4300, and then we take it from there. Now we zoom out to a weekly chart for the SPX, the cash index. The RSI is not really that overbought. You look at the Qs, it is overbought. The SPX, not really. Does that mean it has to go higher? No, but I'm saying if this is going to go higher to become really overextended, really hot in the RSI, it's going to be led by the rotation. In other words, we're going to look at the weekly chart for the Qs. It's way overbought. Is the opportunity there, or is the opportunity here if we have a continuation of the rally? I think the answer is clear. We look at the NASDAQ, the Qs 30 minutes chart. What do we see here? We got the inverse head and shoulder, got us a massive gap higher above the resistance zone. So a little bit of a cheat here, but it stopped pretty much at 370. And now what do we have? The bulls would look at this as a bull flag pattern. Higher we go. The bears would look at this as, look at the RSI, look at the MACD, both overbought. We have a pullback to the R zone, which now becomes the S zone, the support zone, then see what happens. We look at the NASDAQ futures daily chart. What do we see here? Closing above 15,000. Is that bullish or bearish? The answer is, it is bullish. We look at the RSI and the MACD indicators, still in negative divergences. Is that bullish or bearish? The answer is, it is bearish. So what do we do here? We know that the bulls were betting on an ABC pattern. Well, it appears that it is working out. We know that the bears were betting on an inverse ABC pattern that takes us all the way down to closing the gap at around 14,445. Which case appeared to be stronger? The answer is the bullish case. But the bears are still here because they're going to argue that we have a potential for a double top. And then down we go. Is it valid? The answer is sure. It's not the strongest argument right now, considering the closing above 15,000, but if you look at the NDX, the big NASDAQ weekly chart, what do we see here? Way overbought in the RSI. Is that bullish or bearish? It is bearish. You have to look at it from the contrarian lens. We look at the Bollinger Bands. Can they expand higher? The answer is sure. But are we getting to the limit, to the point where we have to pull back and revisit the 20 weeks moving average? The answer is yes. And if we do, that'll be a pullback of about, let's say, 10 to 11%. Now, believe it or not, even if we have a pullback worth 10 to 11% in the NASDAQ, we will still be in a bullish trend. And the reason is, it will still be above the 20 weeks moving average. Now, if the pullback gets us below the 20 weeks moving average, then the bullish trend breaks. But we're not there yet, keyword yet. We look at the IWM and hourly chart. What do we see here? It has been bullish. We spotted the inverse head and shoulder. The bull flag played out. Now what? We got to 188. Do you follow this rotation? The answer is you got to be absolutely out of your mind. The RSIs are out of whack, so is the MACD. We're waiting for a big pullback in the IWM. And I shared in Discord that I talked with a lot of managers. None of them had conviction in rotating into the IWM. Out of all the managers I talked to, I heard healthcare, energy, more technology, industrials, but none said the IWM. And when I asked why, they had no conviction here. They see the opportunity elsewhere. So when you consider what I just said in the intro of this video, that about 40% of the Russell 2000 is unprofitable companies, zombie companies, what do you think will happen to them as interest rates continue to go higher? Optimistic? Sure. But cautious? Hell yeah. And the reason is we could see a pullback to 186.30, fill the gap, and then bounce a little higher, form a head and shoulder topping pattern, and then collapse. We look at the weekly chart for the IWM, the Russell 2000. Does the so-called rotation change anything right now? The answer is absolutely not. We are still within a consolidation pattern, and for all you know, it could break to the downside. Now, if we look at the contrast between the Qs versus the IWM, without a doubt, the opportunity is in the IWM, closing the gap with the Qs. So that's the bullish case for the IWM. The bearish case is the fact that we have yields going higher. And what if the Qs pulls back? And it pulls the IWM down with it. We haven't gotten out of the consolidation range in the IWM, so we cannot declare victory yet. Look at the Dixie 4 hours chart. What do we see here? ABC pattern played out, but then on Friday, big pullback, lost 103 as support. What do we do with the dollar here? The answer is I have no idea. It is inconclusive right now. We looked at the weekly charts. They say nothing. They suggest it could go either way. This chart suggests it could go either way. On the bullish side, you got a pattern of higher lows. Higher highs, higher lows. On the bearish side, you got a loss of 103 as support. Why did the Dixie lose such an important support on Friday? Is it a fake out? Is Tricky Dixie playing another trick here? If it is, what happens to gold? Good bounce for gold on Friday, but do we trust it? The answer is not really. Do we short gold right now? I'd leave the answer to you. It's not for me right now. I'd like to see more before shorting gold. I need to see more in the dollar, more specifically. Am I going to go long gold? The answer is not right now. I want to see confirmation by gold closing above 2,000. Then I'll be in. We look at silver, similar story. We have a wedge pattern. Who's to say that it's not going to break down? Who's to say it's not going to break higher, above 21.57? But I'm not going to pick it up right now until it does. Here's Brent oil, a daily chart. What do we see here? No update, consolidating since May. Actually, since before that. So for oil investors, it has been frustrating. What do we do now? There's nothing we can do beside wait and see. If there is a rotation, it could be positive for energy stocks, regardless of the price that you see right now. We look at the daily chart for the 2-year. What do we have here? We know that we have resistance at around 4.87. So we're facing a little bit of a resistance here. But you look at the weekly chart, you look at the monthly chart, they all suggest we have higher highs coming. If that is the case, it's not going to be good for equities. You can ignore this chart all you want. It makes higher highs. Everybody's going to start shitting their pants collectively at the same time. We look at the TLT daily chart. What do we see here? Big rebound on Friday, but it has been zigzagging within a range. If you want to buy it, go ahead. I'm not going to be in, at least not right now. VIX daily chart, what do we see here? It is defending 13 as support aggressively, almost forming a saucer bottoming formation. We see that the momentum indicators are improving a little bit in the RSI and the MACD. So could it be the bottoming process in the VIX? My hunch is yes. As we head to the earnings season, demand for hedges, demand for insurance will increase dramatically. As we see the month of September coming in, a lot of managers will start to hedge. So I believe that that we are in the bottoming process of the VIX, but we're going to normalize all the way back to 20. Now, if we do have a mechanical breakdown in the market, such as volume getting, for example, we could see a massive explosion in the VIX. But even if that doesn't happen, if we just have a normalization process, the VIX will go all the way back to the 20s, and that's a decent trade. Timing? Who knows? But the strategy, already discussed on Discord. Apple, an hourly chart, what do we see here? Big gap higher. The divergence keeps getting bigger and bigger and bigger here. Look at the RSI, way overbought. We know why. It's the $3 trillion trade. It's the hype that's about to come. Watch out for the tsunami of upgrades on Apple. The tsunami of so-called analysts who are going to come out and upgrade Apple. And that's not good news. We actually see Apple pulling back to closing the gap at 189.6. That'd be a pullback of about 2%. But most importantly, if it does that, might as well go all the way back to the trend line. That would be a downside of about, let's say, 3% or so. If we look at the daily chart, once again, you plug in the Bollinger Bands. Way out of whack. It is due for a pullback, and the pullback gets us all the way down to the moving average, the 20 days in this case. That would be a downside of about 4.5%. We'll look at Tesla, an hourly chart. What do we see here? We talked about the cup and handle. Should get us all the way back to the trend line. We got that. But now what? It is stalling. It is not finding the energy that it needs to ignite, or I should say reignite, the gamma squeeze mania. So if the demand doesn't show up, the sellers are gonna. See, if you own Tesla at 265.25, and then you saw your holdings going down all the way to 240, and you felt dumb for not booking your profits despite the RSI becoming really overbought, well, now the stock is back at the same price. And the psychology goes, okay, I was greedy the first time around. Now I'm not going to be greedy. I'm going to book my profits and move on. And if that is the case, Tesla goes down. Now we'll look at the daily chart for TSLA, the souffle. What do we see here? No markings, no annotations by me. We have a trend line with massive divergence. At some point, we're going to go back to the trend line. In the meantime, can we see a reverse ABC pattern in the making? The answer is yes. Can we see a topping head and shoulder formation? The answer is yes. So again, when we talk about the risk versus reward in the second half, is it in chasing this stock right here? Or is it in fading the stock and chasing other lagging sectors of the stock market? I think the answer is clear. Now let's do some weekly charts in the big caps and see what's going on here. Amazon, at my target exactly at 129, 130. The RSI is becoming really overbought at the risk of pulling back. Can it go a little higher? The answer is yes. We have 138.60, but boy, you're stretching it right now. We look at Google. The RSI is not that overbought, but it is trending down. Yet we don't have a confirmation for any reversal here because Google never closed below 117. We'll look at Meta weekly chart. It is way overbought, but it keeps grinding its way higher. And of course, everybody's eyeing 300. The problem is, if the stock goes to 300 ahead of earnings, it's going to be shorted with both hands. Feet might be involved too. And the reason is, despite all of the layoffs that they've done so far, they keep spending like a drunken sailor on the metaverse. And now they're spending more on AI. Yet their revenues will probably be negative year on year. So the margins are still problematic. And we could see an oversized reaction to the downside here once we get earnings. Microsoft still consolidating here. Weekly chart, double top potential. It's not moving anywhere. The RSI is really overbought. The risk versus reward says if you missed it, you don't want to chase it right now. It's going to come down to the 300 levels, if not even more. And then you get the opportunity to buy it at a cheaper price. But my hunch is when all of these stocks dip, you're not going to like them, because they're going to dip for the wrong reasons. Big misses on earnings, a mechanical breakdown in the market, systemic risk, CPI comes out hotter, Fed says we're going to raise rates even more. You know the deal. Nvidia, weekly chart, what do we see here? Of course, the risk is if this is a distribution pattern, and then we get earnings, stock goes down, and we never see these highs for years to come. Bitcoin, daily chart, what do we see here in tulips? We could look at this as a bull flag consolidation pattern, and higher we go. That depends on the dollar going down. We could also look at this as a distribution pattern, and then down we go back into the consolidation range. And that will happen if the dollar rebounds and continue to grind higher. For me, the opportunity is already done. We talked about the wedge, the breakout. It got us all the way from almost 26,000 all the way to 31,000. I think that's enough. Moving on to the conclusion of this video, what do we have on the economic calendar this week? Monday, the 3rd, we have the manufacturing PMI, ISM manufacturing, and construction spending. Of course, it's going to be half a day. I'm not going to be active. Most of you are not going to be active. That doesn't mean we're not going to have content here in this channel. Tuesday, 4th of July, closed. Happy 4th of July. Happy birthday to the United States of America. Look at Wednesday, July 5th. We have ADP employment. We have factory orders and the minutes from the last FOMC meeting. Those are going to be really important because we need to see the conflict, the internal conflict in the Fed. The doves versus the hawks. And then Thursday, July 6th, we have initial jobless claims. We have the trade deficit, jobs opening, services PMI, and ISM services. And lastly, Friday, the 7th, we have the big one, baby. Non-farm payrolls, hourly wages. All eyes will be on this report. Friday, the most important day by far. Until then, folks, this is all I got for you for now. Once again, thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
It's not an easy situation. But the boys' morale over there is real high. And you can feel confident that we are going to win that war.